This is Komal Tyagi from Team Taxmann, and I am pleased to welcome you all to today's live webinar on Decoding GST for Real Estate Sector, Part 2. I wish to start with a brief about Taxmann. We are the leading publisher of tax and corporate laws in India. We maintain the largest and the most accurate online database on Income Tax Act, International Taxation, GST, Company and SEBI Law, IBC, FEMA Banking and NBFC, Competition Law, Accounts and Audit, and Indian Acts and Rules. Over the years, we have worked strenuously to offer the solutions that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services and take the tax practice to a newer height. We have also developed the national website of the Income Tax Department, and we maintain it with the help of our technical team and the editorial. Now, I welcome our speaker, Mr. Tushar Aggarwal. Mr. Tushar holds an experience of more than 10 years in indirect tax. He has worked for more than 8 years with Lakshmikumaran Sridharan Attorneys. He was also deployed with GSTN for GST implementation and has worked closely with the government officials. Tushar specializes in advising clients on complex indirect tax issues, structuring business operations, identifying and advising on tax-efficient business models, etc. He has been involved deeply in various sectors, including real estate, hospitality, aviation, infra, etc. Thank you, sir, for being with us. Now, before we proceed, here are some tips for the participants. Your mic will be on mute. However, you may post your questions in the chat box available on your right-hand side. Your questions will be answered by the speaker during this session or after the session by our R&D team. A copy of the presentation on the subject matter shall also be sent to you in email for your future references. Now, without taking much time, I request Mr. Aggarwal to address the audience. Over to you, sir. Thank you.
Thank you, Komal. At the outset, I thank Taxmann for providing this opportunity. Good afternoon to all the participants. Friends, in last session, part 1, we had discussed various case studies in respect of real estate sector, such as taxability of various kinds of charges being collected from the customer, GST on cancellation of units, GST on sale of plots, reversal of credit on obtainment of completion certificate, occupation certificate, etc. Now, in today's webinar, we will be discussing one of the most important aspects of real estate, that is joint development agreements, a very, very important concept of under real estate sector. We will be discussing the implications of joint development agreement both from the perspective of landowner as well as developer, and we will include commercial projects, residential projects, and plotted colony while we analyze the taxability of joint development agreements. And if time permitted, in the end, we will look at other case studies related to real estate sector. So what do you mean by joint development agreement? And what is joint development in a real estate? In very simple terms, whenever we talk about joint development, there are two parties who are involved. One is the landowner, second is the developer. Both parties come together for development of a project. Landowner contribute his land, the developer undertakes the development of the project and sell it in the market, and then they share either the revenue or the area. So why do we need joint development? First, it may be because of land ceiling laws. Second, there are so many times that a particular landowner doesn't have an expertise. He is a farmer. He's owning a couple of acres of lands, which is at a good place, which can be commercially exploited, but he doesn't have that resource, that power, even the guts to take the risk, etc. In such a situation, developers comes into picture, and he, with the expertise in development and sale of a project, enters into a joint development agreement with the landowner. So whenever a joint development agreements are drafted, generally the attributes are, first, from landowner perspective, he contribute his land for the construction of the project. And then from developer perspective, it is the responsibility of the developer to undertake the entire construction, entire development, entire sale. At the time of JDA, the landowner also gives power of attorney to the developer so that he has requisite power to obtain various approvals, to perform various legal formalities, etc. He is also given the right to undertake conveyance on behalf of landowner. So joint development doesn't mean that both landowner and developer together are taking the risk, together are constructing and developing the project. It is not like an association of person. Even though the name is joint development agreement, the role and responsibility of landowner is clearly defined. The role and responsibility of developer is clearly defined. Landowner role is limited to giving of land. That's it. Then the entire risk, entire reward, everything is on the developer. He has to develop the project, he has to sell it, he has to market it. So the roles, obligations, and responsibilities are clearly defined and demarcated in a JDA. So essentially, landowner, the activity, the underlying activity of the landowner is nothing but giving of the development rights to the developer. So he gives the development rights to the developer so that developer can develop the project and sell it in the market. And whenever the project is developed, it's a joint conveyance deed which is executed. Developer executes a joint conveyance deed, and he has the power of attorney in his name, which is issued by the landowner, so that he can actually convey the land part also. Because whenever the developer will convey the flat to the customer, it will convey both the superstructure ownership as well as the underlying land. And it is the underlying land. He is not the owner of the underlying land, so it is on the basis of the power of attorney which he obtains from the landowner, which he conveys. So this transfer of development rights in a JDA by landowner to developer, what is the nature of this development rights? Let us understand that. The nature of development rights. Development right is nothing but a right to construct, own, and sell the superstructure. I repeat, it is a right to construct, own, and sell the superstructure on the land. It entitles the developer to carry out the development. And I repeat, these particular development rights entitle the developer to carry out the development and commercially exploit the land. So whenever they transfer the development right to the developer, this development potential of the land is separated from the land and is transferred to the developer in form of transfer of development rights. So development rights effectively is nothing but a benefit arising out of land. It is in the nature of profita prendere. So it is a benefit which arises out of land. Remember, it's a right to construct, right to own that superstructure, and then right to sell that superstructure. Construct, own, and sell. Very important aspects of a development right. Time and again, the nature of development rights has been discussed by courts in India. Some of the landmark judgments are in the case of Chadda Housing Development Corporation, then Sadodaya Builders Private Limited, etc., wherein the courts have held that considering the nature of the development right is nothing but a benefit arising out of land, and hence it is an immovable property. So courts have consistently held that whenever I transfer the development right, I am transferring the development potential of a land. And this development potential of a land, which gives the right to own, construct, and sell the superstructure, is nothing but a benefit arising out of land and hence an immovable property. So after considering the concept of development rights, let's move on to discuss the taxability of development rights, whether service tax or GST is applicable on sale of development rights or transfer of development rights or not. When we talk about service tax regime, prior to negative list of services, when negative list of services was introduced in India effective 1st July 2012 only. So prior to that, only selected services were taxable. And the transfer of development right was not covered under any of the service. So there was no GST or no service tax on transfer of development right before 1st 7 2012. After 1st 7 2012, negative list of services was introduced and every activity was covered under the definition of service except one activity, that is transfer of title in goods or immovable property. So transfer of title in goods and immovable property was specifically kept outside the ambit of service tax law. So the issue during service tax regime was whether this transfer of development right is a transfer of title in immovable property and hence outside the concept of service tax. My view is that development right is nothing but an intangible immovable property. It is a benefit arising out of land as held by various cases. And since the service tax law specifically excluded transfer of title in immovable property, therefore the transfer of development right will be not leviable to service tax. However, one very important point to be noted is that transfer of immovable property in India can only be through a registered deed. If I enter into an agreement to sell my property to you, an immovable property to you, it is not a sale which is executed. Sale in India of an immovable property can be executed only through a registered deed as per section 54 of the Transfer of Property Act. So whenever in service tax regime, I used to enter into a joint development agreement, people used to get these development agreements registered under the as per the local transfer of property laws. They used to get registered and pay proper stamp duty on these joint development agreements. So if a joint development agreement is properly registered and proper stamp duty has been paid, then there is a transfer of development right, and we can qualify that transfer as a transfer of immovable property and hence no tax is leviable. However, if the JD is not registered, then taking this argument that it is a transfer of immovable property will be subject matter of dispute. In fact, there was an internal circular issued during the service tax regime by Gautam Bhattacharya ji, which also stated the same. And in fact, we have a very landmark judgment of Honorable Tribunal in the case of DLF Commercial Projects Corporation, which held that no service tax is leviable on transfer of development rights under the service tax regime. Still, it is a disputable matter. Authorities at ground level has issued show cause notices to various landowners on account of transfer of development right transaction under the service tax regime. Now, moving on to the GST regime. GST got introduced in India effective 1st July 2017. After GST, the way law was drafted, if we compare under service tax, the exclusion was transfer of title in immovable property. So the word used was transfer of immovable property, which was very wide. Immovable property includes both tangible immovable property or intangible immovable property. Whereas in GST, the exclusion under Schedule 3 is sale of land. So supply of goods or services will not include, like this particular activity will not be treated as supply of goods nor supply of services, and the activity is sale of land. So there is a difference in the exclusion, what was there in the service tax regime and what is there in the GST regime. In GST regime, it is restricted and it only talks about sale of land. So when I'm transferring development right to a developer, I'm selling a land? No. Land consists of various properties, various rights, and one of the right is ownership right. So whenever I transfer the development rights to the developer, I only transfer the development potential of the land to the developer and not the ownership right. Hence, it's very, very difficult to cover development rights under the scope of sale of lands. And accordingly, when GST was introduced in India, many builders at ground level also started charging GST on transfer of development rights. At that time, the transfer of development right was covered under forward charge mechanism, and it was the liability of the landowner to pay tax on transfer of development right. So let me give an example. I am a landowner. I transferred my development right to a developer and say for a fixed consideration. I said that developer, you develop, you sell it, you keep the area and the revenue, whatever you earn from the development. I just need a fixed income of say 10 crore rupees. Pay me 10 crore rupees and I am transferring you the development rights, and later on wherever you want to do the conveyance of the land, you get it done. So there is a transfer of development right which is leviable to GST. But the moot question which was being discussed during that moment of time was that whenever I'm transferring, I'm getting whatever amount which I have got, say 10 crore rupees. Okay, I understand it's a transfer of development right, and development right is not covered under Schedule 3. It is not sale of land, and hence there is a GST exposure. But ultimately, land is also going out of from me. Ultimately, when the project will be completed and conveyance deed will be executed in the name of the ultimate customer, my land will also go with me. So entire 10 crore rupees which I have received, you cannot attribute the entire 10 crore rupees only to the value of development rights. My actual ownership of the land is also getting transferred to the ultimate buyers, or hence entire 10 crore rupees has to be vivisected with in two parts. One, a consideration for development rights. Second, the consideration for conveyance. So that is a gray area which is going on in the industry. Now, after first for 2019, there was a paradigm shift in GST. New rates came into picture, and landowners have been excluded from the ambit of development rights. So there is no tax on development rights in the hand of landowner. Entire tax has been shifted under reverse charge mechanism on the developer. So before 1/4/2019, transfer of development right, GST was payable, tax was in the hand of landowner. After 1/4/2019, transfer of development rights, landowner is out of picture. Tax, if any, has to be paid by developer under reverse charge mechanism, and they have bought out certain exemptions also, which we will discuss subsequently. So, basis this discussion, what we can gather is it is very important for us to determine when the joint development agreement was entered, whether it was entered in service tax regime, whether it was entered before 1/4/2019, or it was entered after 1/4/2019, and accordingly the implication will differ. With this background, let us now proceed to discuss the joint development agreements and the taxation in respect of such agreements. We will be discussing joint development agreements which have been entered after 1/4/2019. So coming few slides, we will discuss what is the current position which is there in the GST law, and thereafter we will have few case studies to discuss the transitional issues. What if service development right entered in service tax regime, but I'm sharing the area right now? So all these transitional issues, etc., we have certain case studies. We will drill down into that also. But firstly, we will discuss the implication on area sharing and revenue sharing agreement, both for commercial project and residential project. And all these implications are valid if joint development agreements are entered after 1/4/2019. What is area sharing and revenue sharing in a JDA? Simple. Landowner transfers the development rights to the developer, and in return he wants something. So the consideration which he gets can be in form of area sharing. Say a developer has developed 100 flats and he says, I will give 30 flats to the landowner. That is called area sharing, wherein landowner gets percentage of the build-up area. Revenue sharing, I transfer the development rights to the developer. Developer builds the entire 100 flats, sell the entire 100 flats in the market, and whatever revenue is generated, he shares, say, 30% of the revenue with me. So ultimately get the revenue from the developer. That is called revenue sharing. And before we drill down into the GST part of these JDAs and these area sharing and revenue sharing agreements, important to note what we have even discussed in Schedule 1, but I'm repeating for the benefit of all. After 1/4/2019, entire projects can be classified into two categories, RREP and REP. RREP stands for Residential Real Estate Project. It is a project wherein the residential area is more than 85%. The carpet area of the residential apartment is more than 85%. In other words, residential real estate project means a project wherein the commercial area is less than or equal to 15%. And this project has to be seen RERA wise, not license wise. So within that RERA, your commercial apartments carpet area should be less than 15%. Then it will qualify as an RREP. RAP is all those projects other than residential real estate project. That is called RREP. So let's first start the discussion on revenue sharing arrangement. Let me give you an example. I am a landowner, you are a developer, and we are developing a residential real estate project. That is, in this project, 90% of the unit is residential units and 10% of the unit is commercial units. and I will be transferring development rights to the developer. You will be building 90% residential units, 10% commercial unit. You will sell these units in the market, and I will get 30% of the revenue. So this is the transaction. Let us discuss the tax implications on various subsets involved in this joint development agreement. First is sale of units to the end customer. So developer, whenever he will sell the units to the customer, he will charge 5% GST or 1% for affordable, and non-affordable is 5%. And commercial part is also 5%. I'm talking about effective rate. That is the first transaction, sale of unit by the customer. Second transaction is transfer of development rights by landowner to the developer. In this case, there is no tax liability in the hands of landowner. I repeat, there is no tax liability in the hands of landowner because everything is covered under reverse charge mechanism. So whatever development right, whatever GST liability on development right is there, it is on the developer who has to pay under reverse charge. So in case of a residential project, they have exempted development rights. There is an exemption provided on transfer of development rights for a residential real estate project in respect of residential units which are sold before CC. So there is no GST which is applicable on transfer of development rights to the extent it pertains to residential units which have been sold before OC. That is totally exempted under the GST law. However, those residential units which are sold after OC, developer is liable to pay under reverse charge mechanism on the development rights part. So in our example, 90% unit was residential unit, 10% unit was commercial units. So 90% units, out of 90% units, 85% units was sold before OC. So there will be no reverse charge liability on the developer because it is an exempted transaction. However, with regard to 5% units which are sold after OC, since no output tax is payable on those 5% units which are sold out of OC, in the notification, it is clearly written that the developer is required to pay tax on those 5% units which are sold after OC under reverse charge mechanism, and the maximum tax which is payable is 5% of the unit value. So effectively, what the law is saying that I want to recover effective rate of 5% on all the residential units. So if you are selling residential unit before OC, I will charge 5%. And you charge 5% from the customer and deposit with us. If you are selling residential units after obtainment of occupancy certificate, no output tax is chargeable because it is a sale after OC. In that case, please pay under reverse charge mechanism under the head transfer of development rights, and the rate will be 5% on the value of the flat, and that is the maximum value which I have to pay. That is the maximum tax which I have to pay. So they have kept residential units sold before OC and residential units sold after OC at par whenever we are talking about the GST costing, both 5% at par. With regard to the commercial units, that 10% commercial units, am I eligible to pay under reverse charge mechanism on the TDR part? Yes, the answer is when we strictly read the exemption notification, the exemption notification provide exemption only in respect of a residential units in a real estate project. I repeat, it provides exemption only in respect of residential real estate, residential units in a residential real estate project. No exemption is provided to a commercial units in a real estate project. So the availability of exemption is highly disputable in the light of the wordings which are there in the exemption notification. Practically many of the developers are not paying at ground level. So if you want to pay and discharge GST on the commercial part also, 10% part also, the value will be whatever consideration I am receiving. Say in my example, I am receiving 30% of the revenue. So that 30% of the revenue into commercial units upon total number of units into 18%. That will be my value which I have to pay under reverse charge mechanism, and I will not be in a position to take credit also because my commercial units are chargeable at 5% and not 12% in RREP project. So in case of RREP projects, my residential units 5% no ITC, my commercial unit also 5% no ITC. So if I pay tax under reverse charge mechanism, it is a cost to the developer. So effectively, the intention of the government is very clear. They have generally exempted the way the entire scheme has been drafted. They have exempted development rights for those units wherein you are paying under 5% and not taking credit. But there is a lacuna in the language used in the exemption notification for the commercial units in a residential real estate project. So that's a gray area which is already going on into the industry. 90% of the developers are not paying under reverse charge mechanism on the commercial units part. Moving on to a commercial project. What we earlier discussed was tax implication in case of a residential real estate project, RREP, wherein commercial area was less than 15% of the total carpet area. Now we will be discussing the tax implications on commercial project. So let me take an example. I am a landowner, you are a developer. You want to develop a commercial project. So I will be transferring development rights to you. You will be building, say, 100 units, selling those units to the buyer, say each unit worth 1 crore rupees. So 100 crore rupees is your sale, and you will give me 30% of the revenue to me. I will get 30 crore rupees in return. So this is the nature of the transaction, the joint development agreement. The first transaction is sale of unit to the end customer, chargeable at 12% GST rate, and input tax credit is available to the developer whenever they are building a commercial project. Output rate is 12% with full ITC available. Second transaction is transfer of development rights by the landowner to the developer. On that transfer of development rights, no tax implication in the hands of landowner. However, developer is required to pay under reverse charge mechanism. So developer is required to pay under reverse charge mechanism 18% GST. I repeat, on development of commercial projects, whatever development rights is transferred by a landowner to the developer, developer is legally bound to pay GST under reverse charge mechanism on this development right. What will be the value? Value will be the revenue which I have obtained. So revenue I have obtained is 30 crore rupees in my example. So department is asking me to pay under reverse charge mechanism 30 crore into 18%, 5.4 crore rupees under reverse charge mechanism. And whatever ITC, whatever the GST I pay under RCM on the development rights, I will be in a position to take the credit of the same. I will be in a position to take the credit of the same. It is not a loss to me. The real issue is, when do I pay the tax? If we see strictly the way provisions are worded, the tax liability arises at the time of transfer of development rights itself, irrespective of the fact that I will get this 30% revenue over the period of next 4 years, 5 years. So whenever developer will build the project, he will sell to the customer will pay to the developer, and developer will give me 30% as and when realized. But my liability arises at the time of transfer of development rights only. So in this situation, there may be a cash flow issue in the hands of developer. One of the, let me give you a structuring option for managing the time of supply. If I draft my joint development agreement in such a manner that the role of landowner goes beyond 3 months and he is involved in some decision making, and some scope of activities are given to the landowner in such a manner that his activities and role extends beyond a period of 3 months, though the project runs for 5 years, okay. But what I am talking about is his role for a period of more than 3 months, that he has to help in getting approvals, blah blah blah, some kind of roles, genuine roles in building the JDS. Then the activity of landowner, since his role is for more than 3 months, his activity will become a continuous supply of services. And in case of continuous supply of services, tax liability will arise as and when the payment is due. Since payment is due at later point of time, accordingly my implication will change, and I have to pay under reverse charge mechanism as and when I pay to the landowner. But this is possible only if the JDA is drafted properly, the clauses are mentioned properly. To conclude, in case of revenue sharing, now I am concluding the revenue sharing agreements part. For an RREP project, transfer of development right is exempt. Developer need not pay under reverse charge mechanism. Only on unsold units he has to pay under reverse charge mechanism, residential unsold units, and on commercial units there is a gray area. Whereas for a commercial projects, no exemption provided. developer has to pay under reverse charge mechanism 18% on the revenue given to the landowner. However, it is creditable to the developer, no loss to him. Moving on to the area sharing agreements. Area sharing arrangement in case of RREP projects, that is residential real estate project. Let me give an example. I am a landowner. I have transferred development rights to you. You are a developer. You will construct 100 units. All 100 units are residential units, and you will give me 30% units as a part of transfer of development rights. So this is the transaction, and it's a 100% residential real estate project. It's a 100% units are residential units. First scenario, sale of units by developer to the customer. So in this example, your developer is retaining 70% units and 30% units he is giving to the landowner, that is me. So in respect of those 70% units retained by the developer, whenever he sells to the customer, he will charge 5% GST, no ITC available. With regard to the units given to me, to the landowner, developer, those 30% units, developer is required to pay GST at the rate of 5% on the market value of similar kind of apartment. So there is a second transaction is sale of units to the landowner by the developer. Whatever area they are allocating to me, there is a GST liability on that particular area. 5% is the GST rate. Value is value of similar apartments which is being sold by the developer. And the time of supply is any time before OC. So I can pay this tax at the time of OC or any time before OC, this particular tax. The third leg of the transaction, transfer of development rights to the developer. So we have already discussed landowner, no tax implication, development rights, developer has to pay under reverse charge mechanism. However, there is an exemption provided, that is no tax on residential units sold before OC. So there is no tax on transfer of development right in respect of units which are sold before OC, exemption provided. However, if the units are not sold till OC and there are certain units, like out of 70% units, there are 5% units which are remaining unsold, then the developer is required to pay under reverse charge mechanism on the development rights. Either you calculate the value of development rights. In any case, the maximum tax which the developer has to pay under RCM on development right will be 5% of the market value of those particular units which are left unsold. So they have again capped this 5% tax liability to the extent of 5% of the units remaining unsold. Moving on to area sharing agreement of a commercial project. So let me give an example. In case of commercial project, I'm a landowner, you are a developer, you are developing a commercial project, I'm transferring development rights to you. You will develop 100 units and then you will allocate those 30% of the units to me. This is the transaction. So with regard to sale of units to the end customer, you are retaining 70% units and you are selling those units to the customer. 12% GST payable with input tax credit available to you. 30% unit you will be allocating to me. On these 30% unit, you have to pay GST. Say the value of this 30% unit is 1 crore rupees each, 30 crore rupees. So on 30 crore rupees, you will pay GST at the rate of 12%. And as a landowner, I will be in a position to take the credit of this GST paid to you if I am reselling those units to my end customer before OC. So I repeat, whenever developer is allocating, whenever you are allocating units, developer is allocating units to me as a landowner, on this 30 crore rupees, you have to pay GST, and I will be in a position to take credit if I'm reselling this unit. If I'm not reselling this unit, then it will become a cost. So in the development agreements, please clearly mention who will bear this GST element. We have seen practically that many agreements does not capture who has to bear this GST liability on allocation of units to the landowner. Is it the developer or is it the landowner, or both of them have to bear 50% each? So the agreement should clearly mention, in the absence of clear clauses mentioning the person who has to bear this liability, it always is a subject matter of dispute. Two transactions we have discussed. The third transaction is transfer of the development rights transaction. The development rights which I have given to the developer for development of commercial project for which I've got 30% unit, that is 30 crore rupees worth unit. There is no exemption for commercial project. Accordingly, developer has to pay GST under reverse charge mechanism at the rate of 18% on this 30 crore rupees. So developer has to pay under reverse charge mechanism GST on transfer of development rights which he has received from landowner. Value is 30 crore rupees. That the value of the flats which have been allocated to the landowner, 30 crore rupees, and the GST rate is 18%. So there is a liability on the developer under reverse charge mechanism. He has to pay, but he can take the full credit. So when do developer has to pay the liability in case of area sharing? So in case of area sharing, the liability is on the date of OC only. So developer has to pay this liability on the date of OC. Practically what happens is that developer generally sells all these commercial units much before OC, collects all the payment from the customer and deposit the tax. So if they pay under reverse charge mechanism on the TDR part at the time of OC, they will get the credit, but where they will utilize this credit if they don't have an output liability? Because generally in commercial projects, all the output billing is done much before OC. So they may contemplate to pay the tax even before OC. So developers have to manage their cash flow in such a manner that whenever that reverse charge liability should be deposited at the time, they are in a position to utilize that also. So that is a working which every developer has to undertake. Another important area which have to be kept in mind is that at the time of OC, when there are unsold units remaining in a commercial project, then whatever credit the developer has taken, he has to reverse the same. So that credit will also include your TDR credit. So that's an important aspect which have to be kept in mind. So after covering area sharing and revenue sharing arrangement, both for commercial project and residential project, we can conclude following. Transfer of development rights, no liability on landowner, liability is on developer under reverse charge mechanism. For commercial project, no benefit given, pay under reverse charge mechanism. For residential real estate project, RREP, there is an exemption on transfer of development rights. However, this exemption is only to the extent of units sold by the developer before OC. For units remaining unsold as on date of OC, developer has to pay under reverse charge mechanism at the rate of maximum at the rate of 5% of the value of units. For commercial units in an RRPEP, it is still a litigative issue. From landowner's perspective, no tax liability on landowner. It's just that in an area sharing model, whenever the developer is allocating the units to the landowner can get the credit if he's reselling those units, whether it is a residential units or commercial units, RREP, REP, whatever projects. He can get full credit if he's further selling the units before OC. So if landowner avails, the units are allocated by the developer to the landowner, developer charge GST, landowner will pay GST to the developer, take credit, and further use it for payment of output liability when he sells to them in the market before OC. If he sells after OC, no credit will be available to him. There are various issues being raised in the chat box and question and answer also. I will be taking all these issues at the end of my presentation. Now, what we have discussed was the tax implications on joint development agreements which are executed after 1st 4 2019. Area sharing, revenue sharing, commercial project, residential project, we discussed everything. Now let's discuss some of the case studies related to some of the transitional situations in respect of joint development agreements. The first case study, I entered into a joint development agreement with a developer in 2010. I transferred my development right in 2010 only. But because of certain reasons, the project got delayed. And now, during GST regime also, I am receiving either the revenue share of the project or the area share of the project. So development right transferred in 2010. Now I am receiving revenue share or area share as the case may be. What is the tax implication in the hand of landowner as well as developer? Let me first discuss about revenue sharing. Landowner transferred the development right in 2010. At that time, there was no tax in the hands of landowner. Development right was not taxable under the service tax law, and it was transferred at that moment of time only. So even if I'm receiving the revenue today, even if I'm receiving the revenue in 2022 because project got delayed and now I'm receiving the revenue, no tax implication in the hands of landowner, no service tax liability, no GST liability on this revenue sharing element, that 30% revenue which I'm receiving, because the underlying transaction took place in 2010 when the same was not taxable. It is only the consideration which is received now, and hence there will be no tax liability. However, in case of area sharing, now in case of area sharing, the developer has started though the transfer of development rights was taken place in 2010, but the developer started the construction in GST regime only, and now he's constructing and now he's allocating units to me. In the hands of landowner, there is no tax liability on transfer of development rights as it was undertaken in 2010. Now, what about that liability in the hands of developer? Whether on allocation of units to me, he has to pay GST or not. See, when developer is developing the project for which he has got the consideration in 2010 only in form of DDR. So he got the consideration in 2010 only in form of DR, and now he is constructing and allocating the units to me. There is a notification available 36 by 2010 which says that no tax is payable by the developer if he has received the consideration before 2010, before July 2010. So relying upon that notification, one may argue that there is no tax liability. But if you don't pay GST on this output liability, ultimate developer will have to reverse the input tax credit also, which he has availed in GST regime. So practically, we are advising our clients to claim the credit and pay tax on the allocation of unit if the construction date started in GST regime. You are availing full ITC and now you are allocating unit to me, even though you have received the consideration in 2010. But it on a conservative side, if you want to discharge liability, better to discharge to avoid any dispute. Otherwise, it will also result into reversal of ITC. Second, I entered into a development agreement in 2015. Still, I am receiving the revenue share. Still, I am receiving the area share. What is the tax implication? In 2015, what we discussed in our initial slides was that at that time, transfer of title in immovable property was outside the ambit of GST service tax. So accordingly, no service tax was leviable on transfer of development rights because it being an intangible immovable property if the JDA was registered and duly stamped. So in this particular case, since the transaction was and it's a one-time transfer, so it's a transaction which was undertaken in 2015 only. So whatever revenue share I am receiving now, there will be no GST implications in the hands of landowner or developer because the underlying transaction took place in service tax regime. At that time, it was not leviable to tax. We have a favorable judgment of DLF also. So today also, as a landowner, if you are receiving a revenue share, no GST implication. As a developer, you are transferring revenue share in your books to the landowner, no implications on you on this particular transaction because the underlying transaction took place in 2015 when no tax was there. However, with regard to area sharing, if you have started construction in GST regime, you are availing input and then you are transferring the unit to the landowner, there will be a GST exposure. Though litigative argument, if you want to take, and if landowner is not ready to give you the GST amount and the input cost is also not much, and you want to take an argument that I don't want to pay any tax on the area sharing given to the landowner in this case state study, the only argument which you can take is that, sir, area sharing, I am allocating area to the landowner, I have to pay GST, but when I receive the consideration, I received the consideration in form of DR in 2015 only. At that time, I should have paid the tax. Since I have not paid the tax at that time, it's barred by limitation. 5 years are over. Hence, I don't want to pay. So that's a important uh, argument which you can take. I repeat, a very important argument that in this case study, wherein you have received a TDR in 2015 and now you are allocating the area to the landowner, in this particular case, you are not required to pay GST. If you want to take that argument, the only argument which is available to you is that you have received the consideration in 2015 only, and the entire issue is time barred. Now, let us move on to the next topic of taxability of joint development agreements in case of plots. So, let me give an example. In case of plots, I am a landowner. I have 1 acre of lands. You come to me as a developer. You come to me as a developer. You develop the and we enter into a joint development agreement. And the agreement states that you have to develop the entire colony, entire plotted colony, the common areas part, sewerage part, parts, etc., etc. And then 70% of the plots will be retained by you, and you will hand over 30% of the plots to me. So it's a joint development agreement of a plotted colony. It's a joint development agreement of a plotted colony, wherein I am transferring the, I am bringing my land, you are developing the land, and then we are sharing the plots which have been developed by the developer. So what is the taxability of this particular transaction? First is, what is the landowner doing? Is landowner transferring any development rights for development of plots to the developer? My answer is no. In case of plots, in case of JDAs of plots, there is no concept of development rights. Friends, what we discussed earlier in that slide was development right is a concept wherein you transfer the right to construct the superstructure and own that superstructure. In this plotted colony, there is no superstructure which is developed on the plot. It's a bare shell. It's only the common areas which is developed by the developer and which is ultimately given to the local authority. It is never retained by them. So there is no concept of transfer of development rights by the landowner to the developer. And this is for the reason that even in the GST law, you will not see even a single provisions of related to the plots. The entire law has been, entire notifications have been drafted considering only high rise projects or vertical projects and not a normal plots. So there is no concept of transfer of development rights from a landowner to the developer. So effectively in this JDA, landowner is bringing the land, developer is performing the construction activity, the development activities of the common area, and helping in marketing the plots to the customer. So in this case, when they are giving me 30% area, so effectively developer is acting as a works contractor to the landowner. In my view, developer is acting as a works contractor to the landowner, and whatever development which the developer is undertaking and 30% area which he is allocating to me, on this 30% area there is a GST exposure, and developer should pay GST as works contract services on the construction done for the landowner area. I repeat, in case of area sharing arrangement in a development agreements for a plot, it is the developer who is a service provider who is providing services to the landowner, and he has to pay under GST as works contract services on the construction activity which he has undertaken for the landowner, and the valuation can be on cost plus 10% basis, and accordingly he can prepare, he can take proportionate credit also. Now coming to the revenue sharing arrangement in case of plots, let me give an example. I am a landowner. I transfer, I bring my land, you develop 100% of the land, you build 100 plots, and you sell that 100 plots in the market of 100 crore rupees, and you give me 30 crore rupees in return. Advanced ruling in the case of Mark Space Private Limited, what they have said, they are saying that, sir, the ownership of the land is with the landowner only. What developer is doing? Developer is only developing the project, marketing the project, and the sale is always by the landowner to the end customer. He only takes a power of attorney, acts as an agent of the landowner, and sell it in the market. So ownership of the land is never in the name, in the hands of the developer, and whatever 100 crore rupees he is receiving from the customer, it is not for a sale of plot, because he is not the owner of the plot. Is the landowner who is actually selling the plot. He's only what the landowner is, developer is doing, he's commercially exploiting this entire land, developing the land and marketing the land. And what consideration he gets in return? He gets whatever he received from the customer minus whatever he pays to the landowner. That is, in our example, he got 100 crore rupees from the customer, he paid 30 crore rupees to the landowner, 70 crore rupees whatever he has retained, tax liability is on entire 70 crore rupees, and that is what this ruling is saying. So in case of plots revenue sharing arrangement, the ruling says that on the amount retained by the developer, tax is payable on the entire amount, that is entire 70 crore rupees. But practically in industry, friends, nobody is following this ruling. This is not a correct ruling. Nobody is paying tax on this manner, and the best way the industry is discharging tax is on cost of construction plus 10% basis. So the best way to discharge taxation in case of plots is based on the construction of cost plus 10%. That is, I'm only acting as a works contractor. So there is a very gray area which is going on in the industry. Different developers are practicing and following different kinds of practices. There is no clear-cut law. Suitable representation has been given by CREDI to the members, also CREDI to the GST Council, also to bring clarity on taxation of joint development agreements in case of plots. So with this, I end my presentation, and now I will be taking up various question and answer, because hardly 9 minutes are left and there are various questions and answers to be undertaken. Rest of the case studies we will be discussing at later point of time. Let me come to the various question and answers in the chat box as well as question and answer panel. ITC eligibility on tax paid under RCM basis in case of joint development agreement after 1/4/2019 to developer. Harshal ji. Sir, as we discussed, there is an RCM liability on the developer. He has to pay GST under. He has to pay GST on transfer of development rights under reverse charge mechanism. So, if it is for a commercial project, in that situation, he will be in a position to take full ITC. However, if with regard to the residential project, that is RREP, residential real estate project, there is an exemption. He does not pay under RCM. However, only for unsold unit, he has to pay under RCM. The developer has to pay under RCM only for unsold unit, and he will not be in a position to take credit in case of RREP. So if the project is RREP, no credit available. However, in case of commercial project, he can pay under reverse charge mechanism and can take the credit. What is TDR and TDR? See, there are two concepts. One is called development rights. One is called transfer of development rights. The only difference is transfer of development rights is prevalent in areas like Maharashtra, etc., wherein these TDRs are in form of certificates which can be transferred. Whereas the development rights in Haryana, Delhi, NCR is by way of an agreement only, and there are no such certificates which are available. So another question by Pranay is, so in case of residential units sold in RREP before OC, the developer will not pay under RCM. Absolutely correct. Then what about the landowner? Whether he has to pay under forward charge? No, there is no GST liability on landowner. Friends, please note that in case of joint development agreements entered after 1/4/2019, there is no liability on landowner on transfer of DR. Joint development background. Whether GST credit of X project can be taken for Y project even if X project is completed with OC. See, what I understand is that you have in a company you're developing two projects. In one project, you are eligible to take credit because you are following 12% scheme. So whatever credit there is in that particular project, you can use it against any other commercial project which is there in your same company, but you can not use it against your residential project which is under 5% scheme. There is a query that JDA dated 28th June 2017 but executed on 15 January 2018. Whether developer is required to pay tax under RCM on unsold residential unit as on OC date. See, so first of all, we have to understand that this concept of developer paying GST on RCM is applicable only in respect of those JDAs which are executed after 1/4/2019 and not prior to that. Prior to that, the tax liability was in the hands of landowner only. So only on those JDAs which are executed after 1/4/2019, the tax liability is in the hands of developer. Now, for those JDAs which are executed before 1/4/2019, If it is executed in GST regime, the tax liability is on the landowner. And if it is executed in service tax regime, we can argue that no GST is payable. Now, in your particular example, you have said that the JDA is dated 28 June 2017, but actually it got registered in 15 January 2018. So in this case, relying upon the local registration laws as well as the stamp duty laws, if the registration is taken within the time period, then this registration goes back till the date of JDA. So we have an argument, and we can take an argument that even you have registered the agreement later on in 2018 when GST came into picture, but effectively the deed was executed on June 2017. In service tax era, you are not required to pay service tax or GST on this particular transaction, and accordingly, there will be no RCM on developer also. In case of plotted development done by the landowner himself, will there be a GST implication? So there is a landowner, he's developing the entire project and then entire plotted project, and then selling these plots, commercial plots or industrial plots to the end customer. The issue is that whether there is a GST on the sale of plot by the end customer, which we have covered in our earlier session also. We can legally argue that there is no GST on sale of plot to the end customer, but there are multiple advance rulings which we have discussed earlier also, creating issue. So the practically what we suggest is that always charge development charges separately from the customer. So if the plot is of 1 crore rupees, better you say that I'm selling this plot of 95 lakh rupees. 5 lakh is my development charges. Pay GST on this 5 lakhs at 18% and avail input tax credit on your construction. Next question is trading in DRC. Whether tax is payable on forward charge mechanism. It's a very good question. Landowner has given TDR to me, and then I am again giving it to the developer. So what will be the tax implication? Whether there is a GST on this. So the law is silent on trading of TDR. So effectively in Delhi NCR cases, there cannot be a trading of TDR. See, trading of TDR is possible only in cases like Maharashtra, etc. In Delhi NCR, there cannot be a concept of trading of TDR. So there is a landowner who has given me the development rights. Now I am again transferring it to a developer. So when I do that, I effectively do nothing but relinquish my rights, and the development rights are actually transferred directly by the landowner to the new developer. I am effectively relinquishing my right, and whatever margin which I earn, there is a GST liability on that margin of the forward charge mechanism, and then developer will accordingly pay under reverse charge mechanism. So in case of trading in DRC, the margin earned by the person in between is taxable. Tax impact on landowner when JDA entered in 2018. So if a JD is entered in 2018, to my view, at that time the tax was payable under the forward charge mechanism, and the tax liability will be on the landowner on forward charge mechanism. There is one another important argument which can be taken, like if the TDR is on 2018, if the JD is entered in 2018, if these are individuals landowner, an argument is possible that it is not their usual business. It's an old land which they have kept. It's their grandfather's land. Now they are just asking a developer to exploit this land, etc. So it's a one-off transaction and not in the nature of business. So that kinds of argument is also available, but we have to see the same in case-to-case basis. While how to calculate the unsold area in case of RREP, in case of area sharing arrangement. So like let me take an example. Your developer is developing 100 units. 30 units he will allocate to the landowner, and 70 units he will retain. And out of 70 units, 65 he sold before OC, 5% he is retaining. So the unsold unit in the hands of developer will be only 5%, because on 30%, whatever he is allocating to the landowner, he will charge GST. On 65 units which he is selling to the market, he will charge GST. It's only the 5% which remains unsold. I think we have answered. Let me take the last question. Area sharing model of residential plots valuation under Rule 36 is cost plus 10% or government value as on the date of allotment. So, what in case of joint development agreement, in case of a plotted colony where I'm developing where I'm giving 30% of the plots to the landowner. See, there are two mechanisms which you can take, and what we are suggesting is cost plus 10% of that 30% area, or what you can do is that you can take the circle rate of the 70% rent retained by me, whichever is higher. So that's a practical situation and which you can undertake. Developer purchased TDR for residential project, but this TDR was not used in construction as its additional FSI was used. So developer sold this TDR to another builder. What is the GST implication on sale and purchase of TDR? As I explained that in Delhi NCR areas, effectively there is nothing called sale and purchase of TDR. See, if I got a TDR, I am not using it, and another developer is coming and transferring this TDR to him, it is nothing but relinquishment of my rights. And effectively, it is a tri-part agreement which I have to enter, wherein it's the landowner who will give the TDR directly to the developer. And in this case, whatever margin I have earned, that will be taxable. Otherwise, we have to look into the exact agreements, etc., to tell you the exact implications, because it's a very general query. So in case of all the sale and purchase of multiple TDRs, when multiple legs are involved, we have to see the way agreements are drafted. With this, now we end our presentation as the time is over. Over to you, tax team. Thank you.
Thank you, Mr. Tushar, for this insightful presentation. This is definitely added to our knowledge on this topic. I appreciate the subject matter and thank you for precisely explaining it to our audience. I also thank the participants for being so cooperative. Thank you all for taking time out of your busy schedule and joining us in the sessions to make them a success. Though we have tried to reply to the queries raised during this session, yet in case you have any further questions, you may please send them to us in writing at sales@taxmann.com. Thank you all once again. We shall soon be back with another vital topic. Till then, stay safe and have a great time. Bye bye.